Does your company have a Section 79 plan? Over the years, small business owners have seen their tax brackets increase and their tax deductions decrease. A Section 79 plan is an excellent solution for any business owner with $20,000 or more in annual tax liability. High-income earners have been subjected to tax rate increases for the past 20 years. Each time there is a federal deficit, high-income earners must foot the bill. International corporations have the ability to take advantage of offshore banking and avoid paying billions in taxes here in the United States. Do you have a high-priced attorney to hide your money overseas? Here's the solution. If your company has a tax liability of $20,000 or more annually, a Section 79 plan will allow you to deduct an unlimited amount of money from your taxes. What is a Section 79 plan? Section 79 plans are based on IRC Section 79, which is a tax code that is over 40 years old. It was introduced to close corporate tax loopholes disguised as bonuses. So what does this mean? You can deduct 100% of the premiums paid on any employee's life insurance policy. You can deduct up to 40% of the premiums paid on your own life insurance policy. You can use permanent insurance plans like Index Universal Life that guarantee returns on your cash value and allow you to take money from your policy tax-free. And best of all, your tax deductions on Section 79 plans are unlimited. What's the catch? There is none. Section 79 plans have no limits on the amount that can be deducted from your taxes, but there are some rules. Here are some key points. Policies must be funded within 5 years. ERISA rules apply. Compensation must be done equally across the board. Compensation must be reasonable. And approximately 60% of the premiums for policies over $50,000 must be included on your employee's W-2 form as income. The IRS has a table that is used to calculate the cost of group term life insurance. This table is featured under IRC Section 1.79-3D2. A Section 79 plan at work. Larry, Charles, and Wendy own a very successful health clinic. They have a staff of 5 and they earned about $1 million last year. After expenses, bonuses, and salaries were paid, they still have a tax liability of approximately $80,000. Here are their salaries. These are the employees that selected option 1 for permanent life insurance. Notice that each person that selects permanent life insurance does not have the same face value. However, each person's face value is a multiple of 2.5 times their salary, which was the agreed upon amount by the owners. This amount will vary from company to company depending on how much your company decides to deduct from its taxes. These are the employees that selected option number 2. Again, the face value of their insurance must be the agreed upon amount of 2.5 times their salary in order to prevent discrimination against non-key employees. These are the employees that selected option number 3. Notice that the face value of their insurance is just $50,000. Employees that select this option will not have to report the premiums paid for their insurance policies by their employer on their W-2 forms because the policies are equal to or less than $50,000. The annual tax savings to the company is $60,214, while the total tax savings for the company over a 5-year term is $301,070. Starting a Section 79 plan is very simple. First, sit down with a benefits specialist and your accountant to discuss your projected tax liability. Second, fill out a census form. Third, your benefits specialist will send the information to a third-party administrator. Fourth, the TPA will complete a proposal and provide the enrollment material. And last, the benefits specialist will enroll you and your staff members into a Section 79 plan. A few more rules. Your company will need to form a C corporation. Since the Section 79 plan is for employees, one must be an employee of a company to be able to take advantage of a Section 79 plan. There is hope. As an owner of a limited liability company, you may agree to be taxed under IRS rules as a C corporation and receive your income through a W-2. This qualifies you to use a Section 79 plan. Yes. If you're the owner of an S corporation, you are allowed to set up a subordinate C corporation to manage the assets of your company. Non-discrimination rules. Section 79 plans must be compliant with the Employee Retirement Income Security Act of 1974, better known as ERISA. 70% of all full-time employees must benefit from the plan. However, they have the option to choose not to participate without it affecting you. 85% of all participants must be non-key employees. Once again, they have the option of not participating without it affecting you. Section 79 plans are funded in terms of benefits multiplied by salary. Thus, you must provide the option of term and permanent insurance to everyone and offer a uniform percentage of compensation to each employee. Special rules for groups of less than 10 and other exemptions. For companies with less than 10 employees, evidence of insurability is limited to a questionnaire that does not require a physical examination. All employers can exclude the following employees: part-time employees, employees employed less than 6 months, and employees older than 65. I'm Walter Hines, owner and CEO of Bison Biz, and here is our contact information. Bison Business and Technology Solutions, your problems, our solutions.